All right, let's move into our last segment here. And Greg, let's have some fun with this one here today. Each and every week, we play a game called Buy One, Hold One, and Dump One on Thursday's show with Coach Greg. He's more of a longer-term thinker. We give him the nickname Old Money Homes for a reason. Big into fundamentals, big into dividend payers. He always looks deep into those numbers and metrics before he makes a decision. He finds 3 different companies, lays the argument out for us. Then we all got to make a decision. Which one would we buy? Which one would we dump? And which one would we hold? Greg, what you got for us today?
And Greg, I got to tell you, I am fascinated by this conversation today, because this is an area of the market I've been looking at lately myself. And I haven't pulled any triggers. So I'm fascinated with what
I know the 3 stocks coming down the pike too, and I'm excited for Greg's analysis as well. These are popular names, right? Entertainment names. They're just popular names.
People know these companies, and
take it away, Greg.
There were some surprises in there. Even when I was doing the research, there were some surprises in there for me too. So I think this is going to be entertaining. This all came about. I looked at XLC this morning. It doesn't look as good right at this moment as it did this morning, but it's on that resistance, ready to break out kind of area there. Showing a lot of strength, much like the S&P 500. It seems to love the bounce off the 50. We just got that recently, so lots of strength in this particular area, and that's why I decided to go to the comms to see what I could find. So went in, tried to find 3 that are closely related. So the 3 stocks that we got were VIAC, Viacom, FOXA, and Comcast. So all virtually in the same business, across the board. Let's start with let's start with Comcast, since Matt's already got it out there. But Comcast, really nice chart here. Pushing up against that 60 resistance there. Been moving really nicely for the last, I think you got a 6-month chart on there. But yeah, looking for a breakout there, much like XLC, in that similar space there. From a raw numbers perspective on this one, Comcast about a $60 stock. Dividend yields 1.68%. It's got 12 years of consecutive dividend increases. Started paying dividends in 2008, which is interesting. The last time we had a crash, they started paying dividends, which is good. Payout ratio is only 36%, so very low. PE ratio is 22. Not high in comparison to the overall market. Assets versus liability. This is one where Comcast really stood out. They got $274 billion in assets versus $182 billion in liability. So those numbers are considerably higher than the other 2 that we're going to look at. That's a lot of weight behind you. Free cash flow, they're sitting on almost $14 billion, so $13.8 billion they're sitting on free cash flow. 2 years of consecutive net income increases. This week I did a little bit of something different. So obviously the weekly options, I've been doing that for the last few weeks there. They have weekly options. Their ROI, approximately 30 days, is about 1.6% at the money. So if you're selling a covered call there, you're looking at about 1.6 there, right at the money. Now, one thing I looked at was institutional ownership. So another thing that I look at, on occasion is, how much do the institutions, these are your hedge funds, your mutual funds, these are the big players, how much of that do they own? Because this is what can drive, when they start to acquire or get rid of stock, this can drive prices. And so it's something I think is important from a fundamental metric to look at. So in the case of Comcast, over 85% of it is owned by institutions, and the current change is only negative 0.25. So really no selling to speak of there on Comcast. Growth wise, you're looking at about 11.3% this year and a healthy 6.5% next year. So overall, you're looking at Comcast, pretty solid company with a pretty solid technical chart as well. So that one was quite decent as far as I was concerned to look at. So when we start comparing the other ones, I'll wait till Matt. So if we go to, it doesn't matter, Viacom or FOXA, take your pick there, Matt.
Let's go Viacom.
Okay. So with Viacom here, $40 price, $41 stock. Dividend yield was the best of the bunch at 2.34%. So healthy dividend. They've got 1 year of consecutive dividend increases, so not as good as Comcast. Started paying dividends in 2003. Their payout ratio is only 24%, so lots of room there for dividends. PE ratio that I could find, a forward PE was 8, so very, very low on this particular stock. Assets versus liabilities right in tune, 53 billion versus 37 billion, so right in tune there. Free cash flow about 2.6 billion. So these companies tend to keep a bit of cash on hand, which is nice to see. Again, 2 years of consecutive increases. They have weekly options. Now, this is the one that I thought was interesting from a cover call perspective. At the money on a Viacom cover call, you got 3.6% around 30 days. Now, looking at the chart, obviously it's a very different chart than what we're used to, right? I guess I kind of skipped by things there, but so if you look at the chart there for me, Matt. So obviously this isn't riding high, much like Comcast was, more trending sideways. So a little bit of chop here, but again, that covered call at the money, I averaged it out to 30 days. It was 3.6%. So a very healthy covered call percentage there. Institutional wise, 70% owned by institutions. Now, this would be the key metric for me. In the last, well, it doesn't actually give the time frame, but they've had negative 17% institutional ownership. So been some institutions dumping that recently.
I can think of one.
Who would that be, Mark?
One that went under.
The Bill Wang, yeah. What was we talked about that on
the hedge fund that died.
Yep.
There you go. Yeah. So a bit of a drop there. But you'll notice that something that I found interesting was, you've got a decrease of 17% of institutional ownership, but it really didn't change the price all that much, right? So I thought that was very interesting about that one. So growth-wise, they're 11.2% this year, 3.4% next year. So kind of in line with what Comcast was looking at. Just overall, again, pretty solid fundamentally. Technically speaking, the picture is very different.
What was the liabilities versus assets on?
It was 52.7 versus 36.6. So say 53 versus 37 billion. Those are in billions. All right. Okay. And finally, our friends at FOXA, 20th Century Fox there. So again, different chart than the first one we saw. Not pushing to the all-time highs there, but not a bad chart. Maybe some reversal characteristics coming into play there. Again, it's not a mover and a shaker like Comcast, but again, very steady kind of sideways action there. Numbers wise, we're looking at $37 stock, 1.3% dividend yield, 0 years of consecutive dividend increases. Now their dividends started in 1970, so quite a long history for them. Their payout ratio is only 13%, lowest of the bunch. PE ratio is 10. So we got kind of a mixed bag when it comes to PE ratios here. Overall, their assets versus liabilities, 23 billion versus 12 billion. So very much in line with Viacom. Free cash flow, 2.15 billion. 2 years of net income increases. They have weekly options, and their at the money covered call was 2.7%. So overall, pretty decent there. Now, the one metric I found very interesting is this company is 98% owned by institutions. And they had a drop recently of about 1.35%. So institutions seems to like FOXA quite a bit. Their sales numbers were about 4.9% this year and very close to 4.0% for next year overall. So some different sales numbers as well. But overall, I found all three of these companies to be somewhat similar in certain areas.
Gotcha. So, all right, three stocks from the communications sector. Obviously, FOXA and Viacom, much more similar to each other than Comcast, but very similarities. There's some similarities between all three. Obviously, Comcast still has their cable networks as well. Let's play the game. Buy one, hold one, dump one. Matt, you're first, man. What do you got here? Where's your head at?
Well, looking at them from a fundamental perspective. How I would personally rank them from a fundamental perspective, and I analyze all these for the Tackle 25 every year, and I would personally rank them, Viacom and Comcast, fairly similar fundamentally. Before the year started, obviously Viacom's been caught up in a lot of the volatility of that hedge fund, But even today, I would consider them both fairly equal fundamentally. I really like Viacom I think I like Viacom more from a potential growth perspective as they establish themselves in the streaming wars versus Comcast more as like I see Comcast as a very safety type thing, capture your dividend, write some covered calls, very consistent. And so I'm going to go ahead and go hold on Comcast. I think it's the one where you're just like, yeah, I don't care. I'll just write covered calls and capture my dividend and, compound gains for the next 10, 15, 20 years. If you're looking at accumulating one, you are debating, in my opinion, Fox versus Viacom. And when you look at these, and they're both similar, but I will go with Viacom. So I'm going to go with the buy on Viacom. And specifically on Viacom, I see something technically. And when we're doing this type of game, I mean, you're talking about picking up a stock for cover call purposes, correct?
Mm-hmm.
Okay. You're not talking about picking up a stock for, hey, listen, let's buy the breakout at 42 and we're going to sell it at 45, right?
No, it's not a swing trade game.
So I do think you could very easily pick up shares of Viacom, write covered calls against Viacom as long as it stays underneath the 50-day moving average. When you look at the last 4 tests of that 50-day moving average, you see it get just hold. You close above the 50, you open up that risk graph and let it fly. I like that scenario on Viacom. You also have some on both Viacom and Fox. They're both in some degree of neutrality. You got that very important weekly support level that has been solidified multiple different times right there at 38.5 as well. Stop loss placement, if you get concerned at all, you can get out of the position underneath 38.5, because if you break 38.5, and I'm talking about a weekly close underneath 38.5, it could be look out below a little bit. There's no doubt about that. There's a reason it's stuck in mud. There's a reason it's underperforming the market. But I like the management techniques on Viacom. So I'm going to go with the buy on Viacom, the sell on Fox, and the hold on Comcast.
Mark.
My reasons might be a little. God, you're splitting a lot of hairs here. You could make a case, right? I don't think there's any bad apples here. I'm going to go the buy on Viacom. Recently, first of all, I think you can make a case fundamentally. And once I like this. I do like the free cash flow on Comcast, but if I could buy 2, I would say buy 2, hold 1. I like all 3 companies, but I don't want a lot of communications. I like the catalyst on Viacom. And when I look at institutional ownership, I also look at it a little bit different. The decline in institutional ownership makes sense to me. Fallout from market cost volatility. Some people shy away from that. I look at institutional ownership maybe a little bit differently. There's room for it to go up. Plus, I think there's catalyst on Viacom from, they've expanded Paramount Plus into foreign markets. I think it has some growth potential. I think there's just some genuine growth here. When you look at the sales growth, once again, a huge metric for me. I want to see revenue. I'm not really a top line guy. I want to see that revenue, and I want to see that revenue sustainable. Go ahead.
Can I ask you a question on Viacom? Because you mentioned growth. Out of these 3 companies, do you feel like Viacom out of these 3 has the most potential as like a Netflix type growth?
Yeah, well, and that's always a wild card, right? And I like those bonus wild cards. So
because I don't see the same amount of like Fox. Not that type of growth potential.
And so when I look, because once again, if I was looking for stability, I like Comcast a lot.
Well, that's why Comcast.
But I think I get that stability in Viacom. I think I get, to some degree, that stability in Fox at reasonable PE ratios, dividend. But I also think I have a growth kicker, which is why, like in my own personal watch list of 100 stocks, I watch Viacom's on there for some of these reasons. It is my communication, like little in this specific area of the market. So I think the growth potential is there. I think the fundamentals are just fine. All 3 of them seemed healthy percentage-wise on liabilities versus assets. I didn't have those numbers. Hadn't looked at those recently. I love the free cash flow on Comcast. Like if you just wanted stability, boring, treat you well, I don't think you could go wrong with Comcast. And so that's going to be my hold. I am a buyer on Viacom, especially if I get a technical signal out of this range. That's a go. I've been waiting for 4 months now for that to occur. Got all kinds of million weekly moving. I got a million layers of stuff to fight through. But, I'm a buy on Viacom, cash flow in between. And Fox, I got to kick one out of bed. So, Fox, you're my sell due to no fault of your own. Just the other two are better for me.
So you guys agree. Okay. And I think the analysis here has been good, guys. And this is a fun one here, Greg. I like 3 stocks from this communication sector, breaking them down. What's interesting, and what was the asset to liability number you gave on Comcast early, Greg? Like
It was 274
to
to
182.
274. That's because they own all the land and the theme parks. I mean, they have different business interests than these other 2 types of companies. Comcast is more of a traditional dividend payer. The dividend was not the tiebreaker for me on any of these, by the way. The fact that it's 1.4%, 1.3% on the other 2, I see those as growth and covered call opportunities. You can pick up 2% on covered calls on both Fox and Viacom. There's a reason why Viacom did make a covered call list earlier in the year. It's a great optionable stock. Comcast pays you about 1.4%, 1.5% on a covered call. They're liquid. They're fine. You add the dividend in there. I don't think anybody's going to fault it. With just the nature of their business models, Viacom to me is the buy down here. I mean, and one thing I like about the chart, Matt, is that where it's holding this long-term weekly range is exactly like you pointed out, where it came down from when we had that Archegos capital management implosion earlier in the year. After that liquidation and all that institutional disownership where they had forcibly had to get rid of their stocks, it's held that range all year long. Okay. It's got some interesting technicals that are developing. That's true, but it still is a wonderful covered call stock, over 2%. It's held a stable range and you know where the floor is. So Viacom's the buy. I'm going to dump Comcast and I'm going to buy FOXA digital assets. I think there's more growth opportunity with FOXA. I like the fact that it's also been neutral and I think it's a wonderful covered call. So Viacom for me is a buy, FOXA is a hold. I will get rid of Comcast just because I don't trust the theme park scenario moving forward, maybe in another quarter. I know the trend is better on Comcast. I'll admit that right now, but I'm buying Viacom, holding Fox, selling Comcast.
You've just had terrible customer service from Comcast, like all of us, right?
I might be biased, sure.
The worst customer service in the planet.
I'm here in Canada. All our same providers are just as bad as yours. Believe me. Believe me, they're Bell, Rogers, they're all terrible. So
gotcha.
Anyway.
I think it's the number one complaining around the world.
Customer service.
Whoever the internet provider is. Yeah,
I agree.
100%.
Yeah.
Greg,
internet or cable. So
Greg,
what did we get right,
thoughts?
Greg? What did we get wrong?
So I loved a lot of the points you guys came up with. This comes down to me to what you're looking for. And like I said, there's a few surprises in here. What I look at when I just FYI here, when I look at assets versus liabilities, and I know you made this point, Tim, 274 versus 182, they own a lot more stuff. To me, it's that spread that makes the difference, right? So if we look at the spread between these, so 23 and 11 is 12, 32, I got to pull that up there, 52 and 36, or what are we there, 14, 16 there. And then we look at here, we're 90 something spread, 90 billion spread. So it's that spread that to me makes all the difference in the world. From that fundamental metric, right? So, you close the businesses down, get rid of the assets and the liabilities. Comcast still sitting there with $90 billion, right? Plus their boatloads of free cash flow. So, from a stability standpoint, those are kind of 2 that I look at. Having said that, one of the other things that kind of overrides this for me is I'm all about collecting cash flow, and I'm all about owning stocks for free and as quick as possible. So obviously Viacom has the biggest dividend yield. They have the biggest covered call yield, whether you go out of the money or, as I did here, at the money. The institutional ownership is still in a position that I'm okay with. If that institutional ownership was below 50% or, something like that, that might give me a little bit more pause. I'm not too concerned that the 16%, like you said, that could be attributed to a hedge fund implosion or whatever. So not really concerned about that. I don't mind the sideways action of the technicals either. I think Viacom gives you a very good opportunity, especially from an investor type standpoint. The other part of that is I look at the sales growth. their sales growth is very solid, right? 11% this year, 3.5% next year. I still think that's very solid, right? It wasn't as good as Comcast, obviously, but still in the ballpark there. The only thing that really concerns me is the dividend increases there. Obviously, I like to see that a little bit more stable. They've only got the 1 year there. Comcast got 12. Anyway, Viacom, long story short, Viacom's my buy. FOXA, because of I like their dividend yield is okay. I really like their covered call, yield as well. I do like the fact that institutions own 98% of this. That does give me a warm, fuzzy feeling. The only problem I have with it is that zero dividend increases kind of scares me a little bit. I prefer companies that keep continually rewarding their shareholders, and it's not been the case for FOXA. So for me, I'm going to dump FOXA. I'm going to hold Comcast. Again, just they're the juggernaut. They're something I can count on. Even if I only get 1%, covered call each month and a 1.5% dividend, that's still going to get me what I want. They're going to be able to weather, any storms. 14 billion in cash flow. That's big for a company of this magnitude. So I like that. Plus, they've got their growth component there, which is good, and everything else kind of lines up. So buy Viacom, sell FOXA, and hold Comcast for me.
Thank you, Greg.
I got a question for Matt. All right, so I've been following, like I said, Viacom for months. Cash flowing here and there. Spot checking here. Then I'll move in and out of it. What do you think is because I always look for all right, I need to buy shares and go long. What's your where would that point be on the technical chart?
If you're looking at picking up shares for cover call purposes?
No, I have this, because I'll go back and forth, sell aggressive cover calls, sell naked puts, go back and forth, done that for Viacom several times in the last several months. But I'm buying shares for positional, low delta now, covered call, that liftoff signal from a momentum.
If you're looking for the liftoff signal, I'm looking at two things. Number one, three things, okay? Aggressive, moderate, and then watch out above. Okay. The reclaiming of the 20 weekly coincides with the 50 daily. You see this on the daily chart here. Let's zoom in. See that? You get a close above that 50, that could be a catalyst, and you could see some algorithms play ball there. That's number one, but that would be extremely aggressive. When you look at the weekly chart, you see the 200-day moving average right there at 42.5. You come back out to the daily chart. 42.5 is right there. You see that coincide with resistance here, here, and here. So you can't see it on the daily chart because it's over here, but the weekly chart does look at 42.5. And then ultimately you have the 200-day daily, which coincides with the previous horizontal pivot right there at 46.5. Ultimately, though, we're talking about weekly confirmation, that's 46.5. Everything else between the 50-day break here, 42.5 there, those are all daily type actions within an overall neutral trend. The neutral trend gets blasted and changes when you break back above the 200-day. And so ultimately, you're looking at it reclaiming the top end of the channel. I think, though, you're perfectly fine picking up shares, writing covered calls now, and then adjusting the covered call to a more lower delta as it does achieve breaking some of these technical areas. Mark, does that help?
I think that is a fine plan.